as you speak with people who know a lot about money, personal finance, investing, they have such unique ways of looking at money and how to grow it faster and how to just think about it differently than the average middle class person does. So I'm really excited to have a conversation today with Mauricio Rauld. He is a real estate syndication attorney and partner in Premier Law Group. He's the author of the book Legal Strategies for Everyone. So, Mauricio, we were talking before the show about counterintuitive financial goals and how, everything that you know about money is wrong. So, tell us why that is. Why do the rest of us have it wrong?
I don't know. I tend to like to, first of all, thanks for having me on. I appreciate it. I like to do everything, I like to do things that nobody else does. So I'm always trying to figure out what does the 1% do, and whether it's, the 1% top father, top husband, top moneymaker, but whatever. I want to be in the top 1%. And if you look at the top 1%, nobody has the traditional financial stuff like, 401ks and all that stuff. Nobody has that. So I don't have a 401k, never haven't had one in many, many years. One of the things we've been talking about, we were talking about a little bit offline, is this idea of how much money you really should be spending versus how much money you should be investing. And I was telling you the story about my mentor, my business mentor, Jim Rohn, who, if you don't follow Jim Rohn, if you listen to this, I highly recommend following him. He, Tony Robbins, you've probably heard of Tony Robbins. He's one of his disciples, worked under Jim. And Jim was telling this story one time about investing, and he was recommending sort of the traditional thing where, maybe not traditional, because the traditional has been like, hey, put aside 10% of your money and invest it, and that's how you retire eventually or whatever. But he was talking about more like try and save 30%, right? And he was saying, spend 70% of your income, put 10% aside for active investments, 10% aside for passive investments, and then 10% aside for charity. That was kind of his model, 70, 10, 10, 10. And he said, look, you're not going to start there. I mean, you're probably barely making it right now. So, but start with the process and the concept. So start with like 97, 111, because he's always talked about this era that people thought, hey, once I have more money, I'll make those investments, or I'll make that difference. And Jim was like, I'm not so sure. Like it sounds easy. Like you should start now. Do 97, 111. It's not about the actual dollars. It's about getting into the habit of putting aside separate amounts so you can invest in those three buckets, right? And then he said something that changed my life forever. He said something to the effect of, he said, meaning Jim Rohn, I couldn't spend 70% of my income. That would be obscene. I was like, what? I could not spend 70% of my income. That would be obscene. He said, I probably spend 10% of my income. That just blew, like mind blown. I'm like, wait a minute. There's people out there that live off 10% and can invest 90% of it. And to the point where if you spent all your money, that would be obscene. I'm like, that was such a mind bender for me that, ever since then, I've kind of worked towards that. In fact, just not that it's anywhere near related to Jim Rohn, but I heard Grant Cardone say something similar as well, where he was talking about, 50-50, like, hey, try and get to a point where you're only spending half of your income, save or invest half of your income and live on the other half. And that's, I think, a foreign concept for a lot of people, because most people say, I'm going to make X amount of money and then I'm going to spend it all. And if I make more money, I'm going to, get a bigger house. I'm going to get a nicer car. And you're always spending more and more money as your income increases. Hopefully your income is increasing over years. And if you look, and if you diagram it in a kind of a little curve, you'll just see that the gap is never increases. If you make more, you spend more, and the gap is always the same.
Lifestyle creep.
And I think, yeah, and I think Brian Tracy, one of my mentors, has something to say about that as well. Meaning the goal here is to, as your income increases, it's very easy to say and hard to do, but if you can maintain your standard of living the way you are today, as your income increases, that wedge or that gap really does increase. And the more and more you invest in that, whether it's real estate, active or passive, or some sort of investment that makes it grow, will just get to your number much, much faster. But that was a huge mind shift, because I went away from trying to come up with a dollar amount. Hey, I need to make $5 million, $10 million, $100 million, whatever the number was, and be more of a percentage, especially because, as we know now, with inflation, you could have a goal to make $1 million at some point, was my goal. And my goal was to earn $1 million a year. Well, at some point, $1 million a year just doesn't do much anymore. I mean, right now it's still quite a bit of money, but 20 years from now, $1 million is going to be minimum wage or something. So couching it as a percentage, like how much money do you make as a percentage of what you spend, or the total amount you earn? How much do you keep and how much do you spend? I like that mind shift, and I've taken that into heart for the probably last decade or so.
Well, I love that. Yeah, so in our family, we aim for around a 60 to 70% savings rate, and we can get away with that for a couple reasons. One, we live overseas. Two, my wife, her work provides amazing benefits. We get free housing. We don't have a car. We have full health coverage for the entire family. Our daughter goes to school for free at one of the best schools in the world. So, we have some advantages there, but we try to live on my wife's income and then save and invest all of my income. So, yeah, I mean, there are so many ways of approaching that structure of savings rate. You said something I wanted to just dig into a little bit deeper. You were talking about how Jim Rohn recommended 10% of your income to go to passive investments and 10% to go to active investments. What do you mean specifically by active investments? I think of passive investments, stocks, bonds, and other paper assets. I think of passive real estate investments like real estate syndications, REITs, real estate crowdfunding, private partnerships that are silent for you, private notes, that sort of thing. When you talk about active investments, I mean, what comes to mind for me is active real estate investments like buying rental properties or flipping houses, but you might mean something else. So what do you mean when you
No,
say
I mean,
active
I'm a
investments?
realistic guy as well. So when I don't think of anything other than, so two things I would think of active. One is what you just said, active real estate. I'm buying a single family or a duplex or a small multifamily. I own it 100%. I'm managing it, or at least I'm hiring a property manager. Maybe I'm doing short-term rentals, which is kind of a combination of real estate and a business, residential. It's just something that's active where you don't just like make the investment and then walk away and have somebody else manage it for you. You have to be actively involved. And then
It's almost like a
businesses too,
side
right? Like,
hustle.
yeah, or start a business. Like a business needs capital, obviously cash capital and time capital, but that's another thing. If you want to go buy, either buy a business or start a business from scratch and you're investing money into that. I think that's what he meant. That's what I meant. I always think between active and passive. But again, I'm in the real estate world like you are. So when I think of active, I'm thinking I'm going to go buy a single family home, a duplex, triplex, fourplex, and then either manage it myself or go hire a property manager. But it's not passive, right? Everybody knows that that's not a passive investment. You're actually working. And in fact, if you're trying to get to your real estate professional status, you've got to show that you're actively involved in those real estate investments.
Yeah, and there is a lot to be said for starting a side business, side hustle, whatever you want to call it. Whether that's real estate based or not, there are great tax advantages to do it. It can balloon into your full-time gig, right? If it's something that you love and you're passionate about, and if it's, successful. So it can offer another off-ramp for your career. I mean, there are so many reasons to do that. So I love that. And one final question for you. You kind of glanced over this at the very beginning, but I thought it was worth returning to. And that was, you said that you're not big on 401ks. So I'm curious about why that is, and what you do for tax planning for your retirement in lieu of a 401k.
Yeah, well, real estate is probably one of the biggest benefits of real estate is the tax planning, or whether
Absolutely.
it's, bonus, especially with bonus depreciation over the last few years, which by the way, I do think is going to come back this year or in 2025. I've been
I think
making
we can
that
all
prediction
agree
for a
on that.
while. Yeah, it's going to come back and it's going to be retroactive. So obviously that's a huge one, that 1031 exchanges where you can defer the tax as you keep buying out. Those are really, really the tax benefits. The problem with the 401k is really twofold, just to keep it super simple. I mean, you could obviously spend hours on this, but the
Sure.
two main reasons would be: number one, your money's tied up and you can't use it until you are at retirement age, whatever that is these days, 59 and a half or 60,
15, yeah.
start taking out. Yeah. And number two, you just get crushed with fees. There are hidden fees. You don't see them. But I remember this with my mom, because my mom was in the stock market at some point and mutual funds and all that stuff. And this was like during the market was crushing it. This was back early, and it was, I think the one year the market was up 20%, and she was like an S&P. It wasn't like she was very concentrated. She was like in broad mutual funds. The stock market was up 20%. Her returns were like 7, because they just
Really?
get eaten up in all these fees and loads and mutual fund stuff. I mean, so for those two reasons, I just stay away from that, and I just much rather do real estate. Now, to be fair, with real estate, you have to put a little bit of work into it. You got to learn. You got to be willing to put some effort into it. Versus the stock market 401k, you just wire over some money and you don't have to think about it for 30 years. But I think it makes sense if you're interested in putting a little bit of effort and learn about finances. I think it's a way better vehicle than a 401k.
Yeah, so I mean, I don't use a 401k either. I mean, as a small business owner, we could set up a 401k for our business. We've chosen not to for the fees, what you outlined. And I do have a Roth IRA that I max out every year, and I've been gradually converting my traditional IRA funds to a Roth IRA. But, in an IRA, you can invest in whatever you want. So I just invest in index funds that have
Yeah.
almost no fees whatsoever, and just track the S&P 500 or the Russell 2000 or other stock indexes. So, there's
And remember,
virtually no
you
fees.
can't, you can buy, you just don't get the tax benefits of the real estate piece. One of the things that actually my buddy just did this, and I highly recommend people do this. And when you have kids, a lot of people put together these like 529 plans for college. You can do that, or you could just buy a single family rental. And instead of putting, $500 every month into a 529 plan, just put the $500 into the rental, even if it's a negative thing. And then over the next, 18 years, there's going to be enough equity in that property 18 years from now for you to more than pay for whatever college. So I just think the vehicle, again, you've got to be a little bit more educated, but your audience knows how it works. And so I think a real estate is just, in my personal opinion, a much better vehicle than a traditional IRA or 401k.
Well, I certainly appreciate the counterintuitive view here on money and personal finance. So, Mauricio, in 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
Yeah, so I'm a real estate syndication attorney. So I help real estate syndicators stay out of jail. That's my primary role. But I'm also a retired asset protection attorney. So folks that come to me for help on how to set up their entities, where to set up their entities, how to put together a plan and protect their assets. So if you're interested in that, probably the easiest way is just to follow me on Instagram, just Mauricio Rauld. I put a lot of content out there. But if you need to get a hold of me, you have a specific question, you can always just go to askmauricio.com, and there'll be a little form there for you to fill out and get a hold of me that way.
Awesome. Well, Mauricio, thank you so much for joining us. And guys, if you enjoy these quick, focused conversations that we have, please rate and review the show. It makes a world of difference to us. And on that note, we will catch you on the flip side. Want the cash flow appreciation and tax benefits of real estate without becoming a landlord? You've heard of REITs and real estate crowdfunding, but you probably don't know much about 5 other ways to invest passively in real estate. So we put together a free video course for you to show you how to consistently earn 15% plus returns from 5 lesser known hands-off ways to invest in real estate. And even more importantly, we'll keep risk front and center in that whole discussion, because really, what's the point of investing for high returns if you also take on high risk, right? So visit sparkrental.com/free to take our free course. Each video is snackable at 10 to 15 minutes long, and the entire course takes less time than watching a movie. Looking forward to chatting with you from